Have you ever looked at a company's finances and wondered how you can tell what's really going on? Well, that's exactly what we're going to dive into today. We're breaking down IFRS, the universal language of business, into 3 super simple ideas that, honestly, anyone can get their head around.
Hey everyone, on behalf of the whole team here at Creative Financial Orientation, welcome. We call ourselves your financial compass for a reason. Our mission is really simple, to help you navigate the world of finance and make all that complexity crystal clear.
Because that's the real secret of accounting, isn't it? It's not just about crunching numbers. It's about uncovering the story a business is trying to tell you. A story about its wins, its challenges, its journey. So, the big question is, how do we learn to read it?
Let's start with a story. It's way easier that way. Imagine a passionate entrepreneur who's finally launching her dream, a coffee shop. She takes her personal savings and starts buying everything the shop needs to get up and running. In the language of finance, everything the business owns is called an asset.
Now you're going to see official definitions like this from the IFRS framework, and they can sound a little formal, but don't let the jargon fool you. An economic resource is just a fancy way of saying anything that can help the business make money down the road. Simple as that.
So in our coffee shop, what are we talking about? Well, it's everything. It's the big, shiny espresso machine making the lattes. It's the cash in the register from that morning rush. It's even the bags of coffee beans in the stockroom and the chairs your customers sit on. If it helps bring in money, it's an asset.
Okay, but wait a second. Where'd the money for that top-of-the-line espresso machine even come from? Well, our entrepreneur got a small loan from the bank to help cover the cost. And that little detail introduces our second key concept. Everything a business owes is called a liability.
You see that word right there, obligation. That is the key. A liability is basically a debt. It's a duty the business has to give something of value, usually cash, to someone else because of something that already happened, like, taking out that loan. For our little coffee shop, that bank loan is the perfect example, right? The business is obligated to pay that cash back to the bank. Another really common one is something called accounts payable, which is just a bill from your coffee bean supplier that you need to pay next month.
So, let's recap. We know what our coffee shop owns. Those are its assets. And we know what it owes to other people. Those are its liabilities. So, what's actually left for the owner? Well, that is the heart of the business, and it's called equity. I absolutely love this definition because it is so clear. Residual interest just means what's left over. It's that simple. After you've accounted for all your debts, whatever remains from your assets, that is the owner's true stake in the company. That's their equity.
In our story, this all started with the personal savings our entrepreneur put in to get the dream off the ground. But equity also grows as the business succeeds and makes a profit. It's the part of the coffee shop's value that she, the owner, can point to and say, "That's mine."
Okay, we've got our 3 core building blocks for our story: assets, liabilities, and equity. Now for the really cool part. Let's see how they lock together to create the single most important equation in all of business and finance.
Just think about it for a second. It's pure logic. Everything a business owns, all of its assets, had to be paid for somehow, right? There are only 2 ways to do that. It was either funded by borrowing money from someone else, which is debt, or it was funded by the owner. And boom, there it is. Assets equals liabilities plus equity. This is the fundamental accounting equation. It must always be in balance. No exceptions. It's the rock-solid foundation for a major financial report called the balance sheet. And check this out. If we just rearrange the equation a little bit, we get right back to that simple, powerful definition of equity we talked about. The owner's stake is just everything the business owns minus everything it owes to others. See how it all just clicks together so perfectly?
This is a fantastic question, and you might be thinking it right now. Why can't our coffee shop owner just make up her own way of reporting things? This is exactly where international standards like IFRS become so important. They create a common, trusted language for everyone.
One of the core ideas in IFRS is something called comparability. When every single business tells its story using the same rules, the same grammar, you can do incredible things. Banks and investors can actually understand your story and trust it. You can compare your coffee shop's performance this year to how it did last year. You can even compare it to that giant coffee chain down the street. Without that common language, it's just chaos, a total mess of confusion and distrust. And that right there, that's the key takeaway. These rules aren't designed to hold businesses back. They're made to empower them. By creating this universal language, they build the trust that's absolutely necessary for getting investments, securing loans, and ultimately, for growth.
And that's what this all boils down to. When you understand these three fundamental pieces, assets, liabilities, and equity, you now know the basic grammar of every single business story out there. You can finally start to read the story the numbers are telling you.
We really hope this explainer has acted as your compass and pointed you in a clear direction. Because even though these ideas are pretty simple on the surface, their power to reveal a business's true story is just immense. From all of us here at Creative Financial Orientation, thank you so much for your valuable time. We really appreciate you joining us on this journey, and we'll see you on the next one.